If you solve an existential risk, you create an enormous commercial opportunity. The financial system is beginning to reorient itself to allocate capital towards achieving net zero. So in other words, companies that have plans for net zero are getting capital. Those who don't are having capital removed from them. One of the issues here is, how do pools of capital, whether they're investors, pension funds, banks, how do they report how well they are positioned for the transition towards net zero? There is a need to develop and standardize these types of approaches, partly as a capital allocation tool, but also for citizens whose money this is, who are ultimately held in these institutions, for them to understand how well their money is positioned for the transition. So we need metrics that are forward-looking, that are anchored in real-world climate scenarios, including on a granular basis by sector, and are dynamic, that, in other words, that progress over time.
But the FSB's charter does not limit it to the banking subsector of finance. It is, in effect, the world's umbrella body for international cooperation on financial stability. FSB needs to ramp up its efforts to guard against non-bank risks that look likely to dominate the next decade. Non-bank investment firms of various types have grown to such a scale that it threatens the financial and economic stability in ways other than imposition of losses on retail creditors. Tighter regulation of banks and the persistently low interest rate environment have contributed to a migration of risk to non-banks. The financial market panic in March of this year revealed how much of the sources of financial system stability risk lies outside banking, with the scramble for cash resulting in market dysfunction. It's wholly unsatisfactory that a bunch of leveraged investment funds should have to be rescued in order to restore order to the most important safe asset market in the global financial system. We're overdue a deep rethink that would result in a more specific and explicit common international framework for ensuring that macroprudential risks outside the banking area, and indeed beyond money market funds and insurance firms that get some attention, are more effectively regulated and supervised.
Now, so far, central banks have been pretty successful at resisting the attempts by populist politicians to encroach on their independence. But at the same time, it seems to me that central banks have become more insecure about the legitimacy, the popular support for this independence. So I think the case for central bank independence needs to be reinvigorated, which means that it has to be qualified in some areas, but reinforced in others. As an example of the former, consider government debt. It might be legitimate for central banks to provide a monetary backstop to government debt under some conditions. Central bank independence also seems especially important to preserve when it will come to the massive triage between bad loans and good loans that will have to happen as we go out of the COVID crisis.
How do we preserve support for global trade and investment and rebuild, as Adam said, the global economy, unless we figure out how to tax capital fairly across borders? Reduce the strong incentives for smaller countries to have low tax rates to encourage the companies to come and locate in their countries. I think it's time to use the incoming Biden administration really to try to push forward with global minimum taxes. The second issue of the priorities is around digital technology. What should be happening now is an attempt really to bring major economies together over the trade across borders of digital technology, which is about data, and it's perhaps starting with the issue of cross-border data flows and supporting agreement on that with these other areas would be, and bringing that expertise would be very important.